Clearly, that risk when it comes to what this means for the opening up is playing across the market theme this morning. What do you see as the biggest risk, particularly as there's a lot that we don't know yet about this variant?
Look, I think it's really, when we look at Omicron, little is known at this stage, but the key difference is twofold. One is the transmissibility side of it, and the other is the severity side of it. So we are really looking over the next few weeks what the hospitalization numbers look like, and if there's extra, weights on the hospitals globally on the back of this specific variant. At this stage, we do expect, the spread to probably be much wider than we're looking at, which really will lead to further lockdowns and restrictions globally. But given we are now much more stronger in terms of vaccinations, I think on the hospitalization side of things will not be impacted significantly. On the markets, however, clearly markets have already scaled back the rate hikes that we were pricing in. Earlier last week we saw, Fed rate hikes. We were looking at 3 rate hikes potentially priced into the market, which have now been cut to 2. And also, I think there is now talk and all eyes on the central bank's meeting in December, where, really looking at the Fed to see whether or not they will indeed accelerate their taper plan or not, depending on what the data we get over the next week or so.
What are the opportunities in the de-risking that you see then?
Look, I think one thing we need to remember is that the Friday price action may imply that maybe, the impact of a new pandemic may already be priced in, the diminishing shock value. And as we scale back and we look at, for example, we look at the UK, when the Delta variant impacted them significantly, the sell-off in the FTSE was much, much more smaller than what was experienced in Feb and March 2020. So as a result, this new variant may see markets soften a little bit, but with a lower extent. So yes, we are seeing, a bit of reallocation from leave your home to stay at home. On Friday, our leave at home basket was down around 3.5%. Stay at home basket was only down about 0.5%. So you will just see a bit of reallocation going forward.
So you don't see this as much of a stumbling block then for global equity markets broadly?
We don't see a big stumble at all. In fact, we know that the market impact, we know central banks will quickly switch to dovish if they need to be, and the liquidity program and playbook that we have in play right now will continue to support the market as we, start to more live with COVID rather than otherwise. Having said that, yes, indeed, VIX is higher, volatility is going to be higher, not forgetting that we are going into a seasonal period where liquidity is, our market flow is much more thinner. Many of the hedge funds and institutional side of the investors are closing their books. So yes, volatility will be higher, but what that really means is that, at Citi, we're looking to potentially monetize this volatility through options.
Mahjabeen, in terms of the data this week, then, it seems a lot more emphasis placed on things like China's PMIs to see how the world economy, how big economies like that were performing going into something that may not be a big stumbling block, but is certainly something that everyone's going to be watching closely for its impact on sentiment, on production.
Yes, I agree. I think it's more about how quick the recovery will be. We were looking at a positive recovery in early 2022. Now, with the advent of this new variant, potentially this will be pushed back to the second half of 2022. And again, the recovery globally will not be even. It will be uneven. So again, here we talk about U.S. Exceptionalism vis-a-vis, obviously, China, where obviously they are struggling with that zero COVID reopening policy and generally are in a difficult situation as we speak.